The comparison rate, the gold standard to allow consumers to compare apples with apples. But as much as its intentions are pure, as the saying goes, the path is paved with. Josh Vecchio here, mortgage broker with Hunter Galloway, the home for home buyers across Australia. In this video, we're going to walk through the dangers in relying on the comparison rate, step by step, so keep watching. And remember, hit that subscribe button below to keep up to date all things property and finance. 1. What do you mean by comparison rate? The comparison rate was introduced in 2003 as an attempt to shed light on mortgage interest rates. At the time, this was a revolutionary idea, and in truth, it was much needed. These were the days the banks charged literally thousands of dollars in fees from application to deferred establishment fees. This was an astonishing large fee when you were discharging your home loan within the first 5 years, whether you were fixed or variable rate. Crazy, isn't it? The banks back then charged excessively for everything and anything related to your mortgage, from maintenance to account keeping. It was extortion at its finest. Fast forward to 2010 and a lot of these shenanigans were abolished, by and large due to the competition created by mortgage brokers and regulatory change introduced by government. Where we are today is drastically different to when the comparison rate was first introduced. Today, it's common for banks to literally throw thousands of dollars to customers to acquire their business. And I've seen this firsthand from customers receiving $2,000, $4,000 and even up to $7,000 from the bank to switch their home loan. The idea behind the comparison rate was to allow consumers more insight on the fees and charges which were included in the mortgage, so that an informed decision could be made. In 2003, this was vitally important. But 17 years on, the concept hasn't aged so well, and you'll soon see why. 2. How it's calculated. In short, the comparison rate looks at 4 things: loan amount, loan term, interest rate, and all the fees and charges. So for example, if you take a fixed rate, it'll take into consideration the fixed rate during its fixed term and the variable rate which is on offer once your fixed is up. When you see an advertised comparison rate, you'll notice that it's calculated based on $150,000 loan amount over a 25-year term. For me, this is where the danger begins, and according to the Australian Bureau of Statistics, the average home loan size is actually $500,000 or above. Times have changed, and so too should the way we calculate the comparison rate. It's because the higher your mortgage, the less the fees and charge have an impact on your comparison rate. Let's see how this plays out in real life. Say we have a home loan variable rate of 3%, and the mortgage has $500 in upfront fees, a $350 discharge fee, and an annual ongoing package fee of $395. Looking at this over a 30-year term, looking at a home loan of $150,000, it would mean that your comparison rate would be 3.43%. But had you applied for a $500,000 loan amount, well, it would reduce to 3.13%. And that's a 0.3% difference. And herein lies the problem. Fundamentally, it's a flawed method of comparing mortgages, and things only get worse as we look at fixed or introductory rates. And stick around, because we'll delve deeper into why this is. 3. Is a higher or lower comparison rate better? Well, your guess is as good as mine. Comparison rates work wonders when you're looking at home loans with very few moving parts, such as a basic home loan. And these are typically low rate, low fee variable home loans. But when it comes to an introductory or fixed rate, we can throw the comparison rate out the window.
Present situation.
Because it's the initial term which makes all the difference. For example, let's say you've got to make a decision for a 3-year fixed rate. Making a decision, you have 2 offers, with the first being a 3% interest rate for its fixed period, with an extraordinarily high comparison rate. But the second has a higher interest rate at 3.5%, but an extraordinarily low comparison rate, lower than the first. So which is a better option? Well, if you stay for the provider for the duration of the term, then probably the second option will be better. But if your intentions are to relook at your options once the fixed term ends, then your first option will be better. So in short, it's better sometimes to choose your home loan rate based on a higher comparison rate, and other times it's better to choose on a lower one. 4. How to use a comparison rate. Looking at how to compare options can be done in 2 simple steps, and doesn't necessarily need the comparison rate to do this. The first step is to consider how long you're going to stay with the home loan provider for. So if you're on a fixed rate, you might be looking at options once the fixed term ends. Secondly, calculate the total costs in this period and compare providers accordingly. Note this should also include such costs as mortgage insurance, as each bank differs slightly. By having a holistic approach, you can ultimately compare apples with apples, and a great mortgage broker will be able to help you do this. 5. My final thoughts. A comparison rate still has a chance to be great again. For this to occur, it would need to consider the borrower's loan amount and the loan term they're applying for. That is to say, how long is it that they expect to stay there? Secondly, it must consider all fees, including things such as mortgage insurance, as this will really allow for a comprehensive reading. And finally, it must heed the bank's propensity to rate creep. This occurs where lenders increase their variable rates outside a cycle. And it means that if you went for the lowest interest rate provider at the time of application, over time, you might actually be worse off compared to had you applied for, say, the third or fourth best option at the time. If legislation changes to force lenders to do just this, then the comparison rate would once again be great. Imagine what version 2.0 could do and how that could drive competition and ultimately benefit the consumer, you and I. So what are your thoughts? Should there be a mortgage renaissance? Type your thoughts below. So it's over to you. Are you looking to buy your first home? Did you know here at Hunter Galloway we help people across Australia? So whether you're looking to refinance, purchase, or buy an investment property, you're in good hands. Simply reach out and call us on 1300 088 065 or visit us online at huntergalloway.com.au. Thanks for watching, and remember, hit that subscribe button below. I'll see you next time.